Since general equilibrium models can be hard to capture in figures and tedious to work with, economists started to analyze markets separately under the ceteris paribus assumption, or more specifically that behavior on this market would not influence other markets. The idea of partial equilibrium analysis, popularized by Alfred Marshall, gave the figure most iconic to economics. This paradigmatic figure has demand decrease with the price while supply increases with the price. Let's say that this depicts a market for bananas. The decreasing demand function follows from diminishing marginal utility. That is, typically economists assume that an additional banana becomes less valuable when one has more bananas already. This assumption of diminishing marginal utility seems fairly innocuous or innocent because it is not that easy to provide examples where the marginal utility of additional goods increases with one's stock. Diminishing marginal utility may be erroneous for attempts to complete collections, and the assumption does not seem obvious for the acquisition of knowledge. Examples of upward sloping demand functions also seem fairly scarce, but may exist locally for given goods and could possibly occur for art or under herding behavior. The increasing supply function follows from the widely used assumption of increasing marginal cost of production. That is, the production of an additional good becomes increasingly costly for a larger size of production. This assumption finds its roots in the concept of diminishing returns proposed by Ricardo. Ricardo argued that farmers would first choose lands most conducive to agriculture or easiest to access, so increasing production would mean that the farmers start to employ less productive land or harder to reach lands. By contrast, economies of scale refer to falling marginal cost of production and may be more descriptive for individual producers in some markets, for example online business. Still, also these companies need to compete for talent, which at some point may again lead to diminishing marginal returns. This market model for bananas will find its equilibrium where demand meets supply at price P star, where the marginal utility to consumers equals the marginal cost of production. Below the equilibrium output Q star, consumers are still willing to pay more for bananas than it costs producers to provide them, so production increases. Above the equilibrium output, some producers make more cost than they can recover through sales, leading to a bankruptcy or downscaled production. Note that this is a dynamic interpretation of a static model. In the static model, out of equilibrium behavior does not occur because everyone is perfectly informed and production magically coordinates to the equilibrium. In practice, however, there are considerations like surge cost, and it is rare to observe a single retail price for nearly identical goods. These type of microeconomic market models are not the most popular amongst undergraduates of economics. Despite its many limitations, to quote Rayworth, in the deft words of the statistician George Box, all models are wrong, but some are useful. Rayworth left the partial equilibrium representation of markets out of her critique on economic textbooks. Let me use the partial equilibrium model to illustrate why taxes on goods are considered distortionary, to show that tax burden depends on elasticities of demand and supply rather than where the tax is levied, and to explain the classic market failure of externalities. To do so, let me first introduce a few terms using this edited figure borrowed from Perman and colleagues. Economists consider the cumulative difference between willingness to pay, captured by demand curve D, and the equilibrium market price, representative for the welfare derived from consumption, known as consumer surplus, and here depicted in the dark green triangle. Similarly, the area between the equilibrium price and the supply curve S, being equal to the marginal cost, gives the producer surplus. Note that producer surplus is not the same as profits unless there are no fixed costs of production. This figure introduces some constant tax on bananas that is levied on producers. The original supply curve depicted willingness to produce for prices after tax. This means that including a tax on each banana shifts the supply curve inclusive of tax upward. And since the tax is constant, running parallel to the original supply curve. Demand equals supply, including taxes, at a lower production level compared to the situation without taxes. We find that the reduction in consumer surplus and producer surplus is larger than the tax revenues obtained by the government. The resulting red triangle depicts this welfare loss known as the deadweight loss from distortionary tax. This figure shows the situation where tax is levied on the consumers. Here the original demand curve was the willingness to pay after tax, meaning that the demand curve including tax is shifted downward. One can see that the eventual welfare effects do not depend on where the tax is levied. Instead, the tax burden is determined by the elasticities of demand versus supply, that is, their relative slopes. Here, the left-hand figure from Wikipedia on tax incidence shows a figure similar to the ones we have just seen. The right-hand figure on this slide depicts that when demand is elastic, that is, responds strongly to price changes, the tax burden is mostly felt by the producers.